So far, the adjustments in the labor market have been modest, not really pushing up the unemployment rate. But we're getting nearer to a point where the outcomes on employment may be less benign. Although job growth remains quite strong, most other measures of labor market strength, or most labor market conditions, have basically returned to their pre-pandemic levels, telling you that things are pretty much in balance. And importantly, we've got metrics that show that the balance between demand and supply of workers has largely normalized. Now, I said we had metrics because I want to show you one. Now, this is a chart that I am sure many of you do not have hanging in your house. If you're an economist, you have to have this, especially a labor economist, but it's a really important graph called the beverage curve. It's received a considerable amount of attention of late. And the reason is because it captures the relationship between job vacancies, which is on the vertical axis, and unemployment on the horizontal axis. If you can think of vacancies as demand for workers, how many firms are posting vacancies, and you can think of unemployment as the supply of workers, how many workers are available to take those jobs. And that black line in the figure, that shows the historical path fitted across the last couple of decades of the dots. The dots show these specific examples in a particular month, and the red dots point to the very recent history. Now, if you look at the very top of those red dots, that's March of 2022, what you see is a lot of vacancies and low unemployment. And that's because firms posted historically large numbers of job openings. They were scrambling. If you remember, firms are scrambling. The labor market is tight. They're scrambling to find workers. They're trying to manage their turnover and their hiring to keep up with the surge in demand that came after we all came out of lockdown. So we exit, we start buying things, we're out in the communities, we're going to restaurants and other places. Firms are trying to keep up, and they post a lot of vacancies, and they have a lot of churn. The consequence of that is we go up what's called the steep part of the beverage curve. You're going to be extremely popular in cocktail conversation now. So we were on the steep part of that beverage curve, vacancies are high, unemployment is low. Now, as interest rates rose and the economy became less frenzied, the vacancy reversed. Vacancy started coming down that curve. You can see this by getting all the way to the April 2024 dot, where you see that over that period of time, we've been sliding down. So we've been sliding down the vacancy curve, or the beverage curve, where you can reduce vacancies. Firms can pull them back. They don't put as many out. They are settling in. And you do all of that without increasing unemployment. It's just fewer vacancies chasing about the same number of workers. Now, this is the part that I showed the chart for, to make this final, to show you this final point. Going forward, this benign relationship where you can reduce vacancies, you can slow the labor market, and it doesn't increase unemployment, may be coming to an end. It's possible. The reason is, if you look at the latest job market data, April 2024, it shows that we're getting very near the flatter portion of this curve. And the flatter portion of the beverage curve means that any labor market slowing that happens additionally could, and I underscore could here, let's underline could, it isn't a must, it could, translate into higher unemployment as firms go past adjusting vacancies and they start adjusting jobs. So all of this is to say that at this point, inflation's not the only risk we face. Hence the balance I mentioned. We will need to keep our eye both on inflation, that part of our mandate, and on full employment, the other part of our mandate, to really achieve our goals.